All right, everyone. I got Mike here with me. Mike is my CPA. He is the CPA. Beautiful soul. Met him through a friend of mine who's actually coming over here this weekend. Got the introduction, sent over my returns. He sent me over a 3-page list of items. And I'm like, Mike, what's all this stuff? And then I had Bryce, who you met on the first call, review it all. And like, dude, this is our guy. So then we started to know him a little bit more, and then his network. And it's just been a beautiful relationship evolved in terms of me sending guys to him to, so he could help them out. And then also him sending investors back my way. And then ultimately what you want is a team where we all went together, where we share resources. Again, he's done some work with Wayne, and you'll meet Wayne on this previous call. That's ultimately what you want out of a team. You don't just want a CPA. You want someone who's going to be doing tax planning, who can share their team and resources with you and knows how to play team ball. They can play well in a team. And that's someone who's Mike done for me. Mike, you want to give them a little bit of your background and kind of what you do, and obviously you know how I appreciate you. Mike won the the MVP for 2020 on my team. So
I've never been called a good soul before, but I mean, basically my background is when I came out of college, I worked for a national firm for 15 years. I spent 2 years in their DC National Tax Department office. I spent 2 years working in the UK, setting up offshore tax shelters for people in the Isle of Jersey and Guernsey. And then I also spent 2 years in LA with them. And then in 2005, I decided it was time to go out on my own. There are now 8 of us. We have 2 offices in Cleveland. One is more bent towards real estate management. The other one is more bent towards taxes. A small office in Florida. We do real estate people. 92% of our practice is real estate-based people, construction, real estate, whatever falls into that category. I always say it's hard to be a brain surgeon and a heart surgeon at the same time. So we kind of stay in our lane through the years, built a pretty good network of people that like to invest in real estate projects. Frankly, at the end of the year, I end up having to turn people down and investing in projects because we just don't have enough projects for people to invest in. So like Ray said, it's been a really good relationship. I love Ray, great guy, a lot smarter than me.
I don't know about that.
I'm better looking though, that goes without saying. But yeah, it's been a great team. And like I said, we are firmly embedded in the real estate industry. And it's a rare time when I don't look at a tax return. I just looked at 2 this morning and found a myriad of errors in both of them that, some of them are terminal, some of them are cosmetic, but mistakes are going to be made. But you want to try to minimize that. But things that are glaring, I saw a return today that just had glaring errors that if the IRS doesn't pull it for audit, I would be really surprised.
That's one of the things Mike did for us. So like we mentioned that on that call with Wayne that hasn't come out yet. But Wayne said one of the biggest things you could do is audit proof yourself. Like asset protection is like just making sure you're audit proof. Like Mike had several things. Hey, why don't you have this check? Why don't you have the real estate professional check? Like just certain things like pay yourself a salary. Like these are things that you should be doing that are basic 101,
Exactly. We can get off this call after I say this because this is my theory of taxation. Pigs get fat, hogs get slaughtered. Everything in moderation. There's a gray area in the tax law. We should utilize that, but we shouldn't be running over into the black side of it. The IRS, the guide is you have to have a 51% chance of prevailing. So the bar is not that high, but that doesn't mean you take crazy chances.
No, and Mike's very good at managing risk reward. And Mike, you do that with your clients. You're like, look, here's the level of risk you're taking. Where are you? Because what's interesting about Mike, and I just haven't, and again, I'm not going to speak for you, but what I've heard of it is you'll give a medical doctor who's very by the book and very asking you a very specific question. Hey, how many hours do I need to think? How many hours do I need to log to be this? And then you'll give me a different answer because you start to understand people's risk profile. And people are going to hang their hat on what you say. You're like, well, no, you're not hanging your hat on me. Like, I want you to understand the risk tolerance.
Yeah, I mean, if I had a nickel for every time you need to put your big boy pants on for this, right, I'd be retired right now. But the answer is, you just don't dive into the abyss. We need to make sure that we can support our position. And you're right, Ray. The difference between you as a real estate professional and a doctor who's trying to become a real estate professional, that's a wide gap. It's hard to support a guy with $500,000 W-2, but he's a real estate professional,
Right. And they're coming to you to decrease their liability. I'm like, no, like this doesn't work for you, right? So I've had a lot of CPAs that were girls, for lack of it, they were afraid of the IRS. Mike's not afraid of the IRS, but give him something he can hang his hat on.
Yeah, the director of the New England IRS called me the Darth Vader of taxation in an audit once.
It's
So
true.
I'll take that. I'm okay with that.
It's true. And then again, just kind of get your recap on taxes. One of the questions I had here, I'm looking now just at my notes here. I feel they're going up. Taxes across the board, it's whether it's the personal tax brackets as well as some of the capital gains tax, and then kind of what do you see, if anything, happening with the 1031 and bonus depreciation? But overall, I think you and I have the same mindset. They're going up.
Well, I mean, we just gave away a lot of free money.
Right.
All right. And the one thing that the Biden administration did and every other administration did before Trump was they released a green paper on what their tax wishes are. And obviously getting rid of the 1031, which Trump also brought up, is something they're talked about. I mean, 1031 goes back to 1922. So I'm not so sure how that is going to happen. But the only provision that they have that they said that would be retroactive is the increase in capital gains of when you reach $1 million. Everything else would be 2022. And the only other, because of that, really the only other thing it really impacts is if you do a 1031 now and you close in January of next year and they get rid of the 1031 next year, you're screwed, pardon my French. So the answer is, if you're going to do a 1031, then you need to do it and close it this year. I am not a big proponent of 1031s at all. I just had a client who, where a 1031 actually worked out for him. He did his first 1031 in 1958 and he died. That's how a 1031 works. You die, it's perfect. No one pays tax. It's a great thing. His widow sold the properties, had a huge gain and paid no tax on it. For me, a tax strategy where you have to die is not a great tax strategy.
I like that. I like that you said that, because a lot of people don't realize, Mike, and that's a question I had further along for you, but you brought it up, so let's bring it up, is a lot of guys will say, they'll think the 1031 is the holy grail. 1031 is really for small time investors. When you invest in a bigger syndication, 1031s become a pain in the butt. So generally what you want to do, instead of doing a 1031 is going to hurt the small investor, that's what I think they're targeting out of this. But the bigger investors use the COST SEG and bonus appreciation versus the 1031, because now, correct me if I'm wrong, Mike, but when you do a 1031, you have to carry over your basis over there. So it limits how much you can depreciate in the future, right? Walk us through that. What are your thoughts on that?
I mean, so basically your carryover basis is $100,000 and you bought a $3 million property. Your depreciable basis is going to be a little bit of that 3 million, but it's going to be around 100,000. You're going to have a huge tax bill every year for ordinary income because you have no depreciation to offset that rental income. And that's one of the pains to it too. The other issue with 1031s is you can't take any cash out of the sale. Any cash you take out of a 1031 sale is called boot and it's taxable.
Yeah.
So you don't want to, like I said, I'm not a huge fan of 1031s. I've seen the person die and it worked out. And I've seen where someone down the road sells a property and has nothing they don't want to buy another one. And they have this huge tax bill. Okay, deferral is really the only game in town. Kicking the can down the road is great. But, when you're selling a property for $3 million, you got a $100,000 basis. That's a problem.
It might be a blessing because now you can then buy something new at a much higher rate and then do bonus and cost tag. So then you pay the taxes on the, so what we're saying is you sell that asset, you're going to pay taxes. But if you buy something new, now you have a new depreciation. Guys, in my opinion, personal, I don't know what Mike says, right now, where the economy is right now, and as high as prices have become, I believe that real estate in general has become much more of a tax play than a cash flow play. Yeah. Again, in the past, it was both, but lately, because prices are so high and tenants aren't paying and you got, harder to collect, it's become much more of a tax play, as a tax shelter. It's a beautiful shelter. That's what I'm really looking at real estate for. Mike, what are your thoughts on that, man?
No, I agree. I mean, a lot of the deals that you and I work on, Ray, we do a cost seg and people they invest $100,000, they get $200,000 worth of depreciation. Well, Uncle Sam has almost paid for your investment through your tax savings. Number one. Number two is obviously that you can't let the tax tail wag the dog. It's got to make good business sense. But the answer is if you're going into a deal and you're getting 2/3 of your money back in year one, why wouldn't you do that?
Right, because at that point you've got an option. You can send the money to the IRS or put it in the deal. So that's really interesting. So we're on the same page there. And then I guess, Mike, what we do a lot through real estate outside of the 1031 where you die and then it passes on to your heirs at a stepped up basis, is there another way, and I'll give you what my opinion is there another way to just set aside the tax conversation entirely other than like retirement accounts or Roth IRAs and stuff like that? Are you a believer in the Roth IRA and solo Ks?
For the right projects, I agree. It's got to be something that looks like it's going to be a home run down the road. You hate to lose the depreciation in your Roth or your solo 401k, you hate to lose that depreciation. But if the deal looks like it's going to be a real winner, why wouldn't you do that and just bury the gain inside your 401k or your Roth? It makes a lot of sense on a lot of projects.
And you and I are on the same page. Like if I have a deal that's heavily tax benefited, I'd rather do it outside of the Roth, right? But if you have a deal that you're going to buy it today and sell it 6 months from now for a triple or quadruple, dude, you might as well do that in the Roth.
If it's a short-term gain, I'm all for Roths and for solo 401ks, because there's not much else you can do with it except for buy a bigger property and get some depreciation, try to wipe out the gain. But if you got what you think is a sure home run, that's a really good vehicle to do that.
All right, cool. So we're on the same page there. And then I guess, what's a real estate professional, and what is the importance of qualifying for one? What are the qualifications? And then kind of walk us through it, because a lot of listeners are really, there's just so much unclarity about that. And it's like, guys, it's not that complicated. You just got to spend a certain amount of, so I just want to hear from you rather than hear from me.
It's not that complicated, but it's really not. It's more subjective than objective. You have to have 750 hours in real estate. And that includes a broker. That includes construction contractors.
Okay.
Real estate managers, guys that are running their own properties. You have to have 750 hours, and it has to be more than half the time you spend working. So, like I said, if you're a doctor with a $500,000 W-2, it's pretty hard to say.
It's tough.
Yeah, it's nearly impossible.
Where it gets flexible, it's like, what if you're in the construction business and you construct single family houses? Well, then now you spend that's like, I don't know, right?
No, construction counts. Construction is a real estate professional.
Okay.
So yeah, it's pretty clear that it is. So if you're doing, and I'm going to use this term, the IRS hates this term, by the way, house flipping, when they hear flipping, if you sit in a meeting with an IRS agent and you use the word flipping, his head will explode. He thinks you're doing something wrong. Sure. If you're doing house renovations and turning around and selling them, that's construction. You're a real estate professional. On top of that, if you're using a partnership or an LLC or a Schedule C on your personal tax return, that's subject to self-employment income. So if you're doing house flips, you want to set up an S corporation and do it that way. You don't want to do it in an LLC or on your own personal tax return.
Guys, that cost me hundreds of thousands year one and year two starting out. That advice right there. Set up an S corp, an LLC, taxes a subchapter S, pay yourself a salary, right? And then don't hold long-term. Again, I'm not going to say that. I would not hold long-term rentals in an S corp. Long-term rentals belong in a LLC, taxed as a partnership.
Here's the rule of thumb: active trader business S corp, rentals LLC, partnership LP, whatever LLP. Never hold your rental real estate in anything but a partnership format. On the other side of the active trader business, it's a 2-page form you need to file with the IRS. So they're not asking you to jump through hoops to make an S election. It's fairly easy. And if you had an active trader business, if you pay yourself a reasonable salary, you're not going to subject yourself to a bunch of self-employment tax. I'm on the other side of 60, and I don't think I'm going to get any Social Security. So you guys on the lower side of 60, all I can say is good luck. It's the world's biggest Ponzi scheme. We're paying for the people that are retired now, and I just don't see us being able to get it to ever recoup that.
One of the guys I had speak, actually Wayne spoke about paying yourself a salary, and so did the guy from the Specialized, Edwin. He said, if you don't pay yourself a salary, you can't contribute to a solo K or a 401k. Like, you need earned income. Like, pay yourself enough of a salary to contribute to these plans. It's silly.
Right. And then there's also banking stuff. If there's that year where you're thinking about your wife has decided that she wants to buy $1.5 million house, you know what? You might have to bite the bullet that one year and jack up your W-2.
Yeah.
Bankers are the least imaginative people in the world. They don't understand depreciation. They don't understand that you're a real estate professional. They need to see hard, fast numbers. I got a guy, his wife's a real estate professional, huge loss. He has a W-2 from Microsoft of over $750,000. They're having a hard time financing $1.5 million home because they don't understand why they have a big negative on their tax return.
Yeah, the bankers don't get it. I mean, unless you have like a small private banker who gets it, a small community bank, but then you're not going to get a 3 or 4% rate. You're going to get a 5 or 6, right? So, Mike, a good point is I see a lot of doctors, dentists, highly paid professional, or even businessmen. Well, they'll have their wife become a real estate professional. What are the advantages to that? Because I've seen that work out well for a lot of our investors that come into our deals.
The advantage is that the losses from the real estate professional offset even the doctor's W-2.
And those are unlimited. They used to be limited, right?
My prime example of that is I have a client that used to be the head of the South American CIA Bureau. He has his own private security, and I use that word security, in quotes, business. And I mean, he's looking at a $2.5 million W-2 and $500,000 coming through his S Corp. His wife is a real estate professional, and obviously they have the wherewithal to buy a lot of real estate. You know, knock on wood, they haven't paid taxes since I took over their stuff in 2012. And she buys good deals. She's made a lot of money off of her deals. You know, like I said, you don't let the tax tail wag the dog. But the fact of the matter is, if you can get your wife to qualify as a real estate pro, and she's on top of this, she's running the properties, she's calling the construction guys, blah, blah, blah. You know, it's a huge advantage.
And then again, you just kind of give her a nice little shopping spree here and there, right, Mike? That's all you got to do. You just say, hey, you want this?
Yeah.
You do this.
Trust me, this woman's going to take that shopping spree. She's not, you know, she doesn't need your permission.
It's a win-win. And again, we're in a similar bucket. We haven't, once we started working with Mike, we haven't paid any federal income tax, but it doesn't mean we don't pay tax. We just don't pay any federal income tax.
I've got a guy, he's disappointed this year. Last year, he sold over $12 million. He had $12 million of gains and cash to go with it. And he owes $100,000 of taxes because he hasn't paid since 2008. He's pissed off at me. I'm like, I can only do so much magic, bro.
You spoil your people. I mean, Mike's so good is we're going back to all the old years to get back all the tax money that my prior professionals messed up. So there's opportunities to do that. So I guess, Mike, my opinion is an ideal client for a deal that offers like strong depreciations. It seems like it'd be the person that's already in a high tax bracket. So if you have a real estate deal that's going to do a heavy cost seg and bonus depreciation, the best guy that would seem is someone who's already in a high tax bracket and or in a state that also has a high tax bracket as well. Like, so the higher the taxes, the more the tax benefits, as long as the deal is a good deal, makes sense. Right. What are your thoughts? Yeah,
that's true. The only caveat I offer there is some states, Pennsylvania, New York, California, they have funny rules about the bonus depreciation. Mm-hmm. So you may not get all your bonus depreciation in year one. You might get it over 5 years. So some states, it's not as great a benefit, but for federal tax purposes, obviously you can wipe out your federal tax liability.
And then Mike, what is a cost seg? And then what is bonus depreciation?
A cost seg goes back to 1966. It's tried and true. The IRS has made a couple runs at it and has never been able to break it down. And basically what you do is you go down and you break down the components of the building and the outside, the parking lot, et cetera. Now, a parking lot is depreciated over 15 years. Certain improvements, bathroom stalls, better doors, you know, hardwood doors, you know, with the fancy lighting and stuff you have in your conference room, an apartment, the swimming pool area, all that, that's all depreciated over 5 years. So instead of being either 27 and a half or 39 years for commercial property, you're accelerating your depreciation. And under 168K, the bonus depreciation, in this year and next year, you're allowed to take 100% of that 5, 15, 7-year property all in year one.
Oh, wow.
So just as a rule of thumb, you know, it's not hard and fast, but you're able to write off about 33% of your building in year one, depending on what kind of property it is and how nice it is. The nicer the property, the more expensive the property, the more depreciation, obviously, you're going to get. The bonus depreciation goes until in 2023, instead of 100%, it's going to be 80%. And the Biden administration has talked nothing about getting rid of that.
To me, that's where the real juice is. And in terms of assets, so that's our strategy right now. What we use in-house is we're looking for the bonus appreciation. If we sell a deal, which right now we're selling a deal we did together, DeForest deal that Mike and I did together. A lot of his investors are in that deal with me. We'll sell it and then we'll look for another deal. But again, if we can find it, we're not going to force it. And if we can't find it, then we pay the taxes. So Mike, let's say, 2 questions. Let's say this deal now, we're finishing up. A lot of your investors get their money back and they can't find another deal. Well, what happened? So now they got to pay the taxes now, but they were able to defer the taxes and go from one bracket to like walk them through how, even if you sell later, it's a deferment, but how does that benefit people, even if you have to sell the deal?
Yeah, under the current tax rates, if that property is held 3 to 5 years, there's some IRS guidance on it. And if it's held 3 to 5 years, you've taken an ordinary income tax deduction with the depreciation, but you're paying it back at capital gain rates. So for federal tax purposes, that's a 17% permanent deferral because you took a 37% deduction and you're paying it back at 20. So it's a win-win if you do that. You know, obviously we do a lot of cost segs. We've been doing them since 1999. I'm a big believer in them. You know, that the IRS, you've never had one looked at as the reason for the audit because of other things. They've looked at our cost segs. And I actually had a manager of an office in DC tell us that out of the 1,500 he's seen, we're in the top 5. So I'll take that.
Yeah,
so
Mike does a great job.
we put together a really nice report, covers pretty much everything, has depreciation schedules in it. And, even if you're using an outside accountant to prepare your tax return, everything is in there for them to do your tax return.
I like keeping it all in one household. Mike will do the cost seg and his team will do the cost seg and bonus depreciation, and then they'll do the return as well for us. Mike, what assets between multifamily, retail, what assets do you see that have, in general, ballpark, the highest tax benefits in terms of a cost seg and bonus?
If you've got an A apartment building, like the one that we know about in Indiana,
sure,
that's a huge, obviously, that was huge dollars. And that one, Ray and I are in this property in Indiana.
And guys, we'll link the video to on the show so you guys can get a deal of what we did. That deal's closed already, but
people got 3-to-1 depreciation in year one.
Yeah,
it's amazing. And on top of it, it's a great property. That there's monthly dividend checks, brother. Nothing better than that.
Well, so, that and year two, you're going to get depreciation too, and year three because you're still doing a lot of
renovation. Yeah.
Right.
So I would say in this day and age right now, A apartment buildings give you the biggest bang for buck. Obviously, the more expensive the property is, the bigger bang for your buck. But commercial, it depends. If it's a really nice office building, if there is such a thing as office buildings going forward, you can get decent stuff there. But you walk into a Dollar General, there's not a lot you can get there. There's a parking lot, there's a loading dock, there might be some extra lighting, there might be some the checkout counters, but you're not going to get a lot of bang for your buck there.
How did the repairs? So let's say someone's buying a big multifamily building and then they're going to come in and do a lot of construction. Can you then, cost seg and bonus appreciate that?
You need to do a cost seg on those repairs. Obviously some of it is repairs. The definition of capitalized item is something that adds value to the property and has a life of over a year. So things that we capitalize, we need to do a cost seg for, and then do the bonus depreciation. Repairs, let's say that a water main broke or something. That's a repair. Now, if we had to rerun a bigger water main because we didn't have enough water coming into the building, that's capitalized, and we'd be able to take the bonus depreciation on.
In essence, you could have a situation where you're doing multiple bonus appreciation so that you get additional tax benefits year 2 and year 3 because of these improvements that are being done to the property.
Right.
Guys, this is an amazing strategy.
Yeah. The more, back to the apartment building we're talking about, as people leave, they're renovating these apartments and they're putting a decent amount of money into them. So, we're looking at, I think they're accelerating a little bit. I think originally it was 3 years, but I think they might be able to do it all in 2. Yep. Yeah, but that means year 1, 2, and 3, you're going to get some pretty nice depreciation.
The weird thing, Mike, is you can't make everybody happy. Some people are still giving me shit like, "Oh, I didn't get enough depreciation benefits." Dude, what are you? I go, "Where else are you getting this?" I go, "Tell me, because I'll go there."
Yeah, and I can probably guess who those people are, but that's okay. But they shall remain anonymous. All right.
Guys who are in real estate, a lot of guys make a mistake in real estate that you need to bring in your CPA and team, because you can get creative with how you structure debt on a deal. So you could have a deal, let's say a multifamily deal, where you have your first position bank, but then you come in and you get a mezz lender, or you get a preferred equity to act like debt. He looks like equity, but she acts like debt. You know what I mean, right? Looks like Tarzan, looks like Jane, right? Right. So if you can get that, what that means is for the investors that are remaining, sure, the deal's a little bit more leverage, but now what you can do is the remaining equity investors, they're going to get a lot more depreciation because a lot of the capital stack isn't participating in the depreciation. And to the guys that have a lot of income, they're willing to take a little bit lower return and a little bit higher risk for more depreciation. What are your thoughts, Mike?
No, I agree. I actually have a client that does syndications, and when you get your ROI, your depreciation benefit is computed in that, because there is a dollar, it's 37 cents federally that you're saving on every dollar depreciation. So, in effect, it should be factored into that return.
One of the things I tell a lot of syndicators, because we're more passive on that, but I tell them, guys, break up your syndication in 3. Break it up for the guys who just want an income, just like a flat return. You give them an 8-10 pref, no upside in the deal, just a straight pref, right? And then you have your solo Ks and IRAs. Break that up into like a class B shares, and they don't take any depreciation, and neither do these guys. And then these guys take all the depreciation, but they get the return after these first 2 hands eat. So these guys will get a higher return if the deal goes well. But if the deal doesn't go well as that, they get a low return, but they get a lot of tax benefits. So figure out, you know what I mean? Like figure out who wants hamburgers, get them hamburgers. Figure out who wants cheeseburgers, and figure out who wants pizza.
I had a question this morning. They're looking at buying a property, and they want to say to their investors, after we do a refi, if you want to get out, you can get out. The answer is your operating agreement is pretty wide open. The tax law under 704, which is allocation of profits and losses, is pretty wide open. You can, like I said to them, you can do whatever you want to do. If someone assigns the operating agreement agrees to it, then that's good. Otherwise, the world is your oyster, as they say. It's wide open how you want to allocate profits, losses, how you want to get preferred returns. There is no template for doing this. It's whatever it takes to get those investors into the deal and make them money.
And guys, we've had deals where we allocate a portion of the depreciation to the investors that need it. As long as all the investors are okay and we disclose it, you can give a certain investor who writes a bigger check or who's adding more into the deal a larger chunk of depreciation. As long as everyone's cool with it, it doesn't have to be pro rata, meaning everyone gets their equal share. Correct, Mike?
Right. Yeah. I mean, there's, almost every deal I see now, the guy that's the big guy who writes the big check, he gets, 20%, 30% more depreciation than anyone else does.
When I've been on the side of the GP side, it benefits me because then I don't have to go have 20 conversations. So I don't mind giving him some of my own personal depreciation because he just saved me a whole bunch of brain damage. And then we spoke about that, Mike. This year, one of the things we're doing is we're going back and amending some returns and getting some tax dollars back. Is this the last year you can do that, 2021?
Right now, 2020 is the last year you can do a carryback. Okay. And for you people that haven't filed your returns yet, you could go back and do cost segs on your properties. You haven't had cost segs, try to generate a loss in 2020 and go back to 15, 16, 17, 18, 19 and get some money back.
We're talking big checks. Mike's got me back big checks. My ROI is positive with Mike because we have, to the extent you have a net operating loss, in 2020, you can go back to 15, 16, 17, 18, 19, 20, and 19 and get those money, get those dollars back.
Someone just sent me a picture of the $750,000 check they got back.
I'm not that big, but
they were pretty happy. Yeah,
I bet they were ecstatic, dude. So again, it's something you can do. And again, let's just say you don't do it, you file a return, you don't do it. But I like what Mike said too, is if you haven't done a cost seg before and you bought the property, you can still do the cost seg now. What they call it, catch up or something, catch up.
Yeah, it's called a 481A adjustment, and basically you compute the depreciation as if you took it on year one, and you catch it all back up now. Right. So there's no amending of returns. It's all in the current year, and it's pretty simple procedure. It's a little bit more work on our end, but nothing that's too arduous. But the bottom line is you don't lose out.
Let's say you already filed it, Mike's not going to go amend, but let's say you want to do 2021, then at that point you just carry them forward.
Right.
Is there any length of time that you're not able to go carry them forward, or you can carry them forward indefinitely?
Right now, forever, yeah, right now.
And then Mike, talk a little bit about the real estate professional, how passive losses via the K1 on a real estate deal, how does that offset the active income, whether you're a real estate professional or not? Like, walk me through that flow of active versus, like, how does the English speaking guy speak to the Spanish speaking guy and figure it out?
If you are getting passive income from real estate, unless your income is below $150,000, you're getting no benefit for the losses there. So that's where the real estate professional comes into play. The only way passive losses is if you can offset passive income. That's it. And if you're below that 150 mark, you get a bonus of 25 grand, up to 25,000 you can take as a loss. It kind of phases out when you hit 100. It kind of ratchets down a little bit. But the answer is that's the benefit of being a real estate professional, is that loss is no longer passive and offsets any other income that you have.
So the big benefit there is any active income you have, as long as you're a real estate professional, can be offset by passive losses. Everything's active now, so everything.
It's no longer passive anymore. It's no longer passive anymore.
Correct.
Yeah.
You're active now.
The real estate losses, yeah.
Yep. Let's say you're not a real estate professional. Can you offset? Let's say you have some gains in selling Amazon stock or Tesla, or you bought Bitcoin at $10. You can offset a lot of those gains because those gains are passive through real estate losses, even if you're not a real estate professional. Is that accurate?
Yes and no. I mean, the answer is right now there's guidance on part of what's going on with crypto, but not everything. So the answer is that.
So maybe yes on the stocks, but no on the crypto, or unclear.
No, the stocks is definitely is called invested income. The crypto is what's wide open right now. Okay. No one really knows how to handle those. You and I are going to confer on that. Right. And I'm not even sure anyone that labels himself a crypto expert right now really knows what's going on. I mean, I've read a bunch of revenue rulings and a bunch of articles and what I would call, pretty good tax journals, and there's just a lot of gray area out there. But, I will say the one thing, you could bet your bottom dollar this is going to be a huge IRS issue.
So let's say you bought Amazon stock and it quadrupled, and then you want to sell. You held it over a year. You have real estate losses. You're not a real estate professional. Those can offset each other, no problem.
No, they can't.
No?
No,
Oh, wow.
no, because one is portfolio and the other one is a passive. So the
what
answer
can
is
you,
no.
so what can you offset with real estate passive? If you're not a real estate professional, what can you offset?
Other real estate income, if you invested in, let's say, I invested in a pharmaceutical company and I get a K1, I don't do anything with it, that's passive. If that has passive income.
So other K1 income from businesses or something else, then you could offset that.
That you're passive in, yes.
So let's say you're a doctor, dentist, and then you have another practice, but in another profession, and you don't actually, it's not your practice, you just invest in another practice, you could offset some of that.
Yes.
Okay, cool. So there is a place in a room and space for that. That makes sense.
Right. Yeah. I mean, I have a couple of buddies I grew up with that are nephrologists, and they've invested in a lot of dialysis units.
Sure.
Now they have nothing to do with those dialysis units by getting a check every month. So that's definitely passive. And they had a huge gain on some real estate. So that passive stuff from the dialysis units offset the gain from the real estate.
Interesting. Here on the crypto side, I do know that they're clear that there's a lot of revenue people are making that they're not getting their hands on. I'm pretty clear on that because they're not dumb. You've seen this, maybe not in this crypto world, but you've seen this happen before where something new happens. I personally don't think they're going to ban it. I personally think they just want their share. They just want their money.
I mean, going back to before you were born in the mid 80s, there used to be this play where you would buy into a movie, and you would, for every dollar you put in the movie, you got $5 of a deduction. It was a huge play. And the Reagan administration couldn't catch up with it. They couldn't figure out how to monitor it or anything. So they just got rid of it. I don't see that with crypto. I think they want their thing. I think the two big things that we're going to have to deal with in the future are bad PPP loans and crypto. The number of bad PPP loans where people, I'm going to use the word nicely, misstated the reason they should be getting them is a lot higher than you think. Sure. Yeah, so I think the IRS is going to be honed in on that. If you got a PPP loan and you didn't use it the right way, and it's over 50 grand, I'd be nervous.
Well, right now, from what I read, the new bill that he put on the floor, Biden, had a lot of money going to the IRS for this. Correct me if I'm wrong, you're the expert, but I read that line specifically, there was a lot of money.
Yeah, in November of 2019, I went to a seminar and the commissioner of the IRS spoke. And normally there's 115,000 jobs with the IRS. They were down to 80,000 jobs. And now I'm going to ask you a question, Ray. How many of those employees, 80,000 employees, were 30 years or younger?
Not many.
2,500. So we've got an aging workforce that during COVID took their buyouts and retired. So they're down now to 65,000. Try getting through on the phone to the IRS right now. It's not happening. And the crazy thing about IRS is it's one of the few federal agencies that makes money. For every dollar spent on IRS, they make $5. So if you were a businessman, where would you put your money?
Sure. And again, it's Biden's been if you're not paying attention, Biden's been very clear about MMT, more money today, and how he's going to pay for it by taxing it. He's been very, very clear of how he's going to pay for it, right?
There's been no hiding.
Yeah, he's going to print money and then he's going to tax. I mean, he's been very, very clear. Mike, talk a little bit about, if you want to compare and contrast, what are QOZ zones, and then how do they compare to 1031 and bonus appreciation? And do you have guys using them, and kind of talk to me a little bit about that?
Everyone jumped onto the qualified opportunity zone bandwagon in a hurry. But what they didn't realize is that you had to double the value of the building in 30 months to qualify as a qualified opportunity zone.
So these are heavy reposition, you're doing heavy work.
You're doing heavy lifting to get there. Okay. And what a lot of guys are finding out is they're not meeting that criteria. So that's number one. Number two is people that rolled money into the qualified opportunity zones at the end of at 12/31/26, the gain is taxable at that time. And what really might whipsaw you is it's a 20% gain right now. What happens if in 26 capital gains are taxed at 37, 40%? You just
went to the opposite. You just went.
Yeah, you just killed yourself. Yeah, you just killed yourself. You just cost yourself 20%, thinking I got this great deferral here because the way the law is written, it's the capital gains rate at that time. So
that's interesting.
Yeah. So the big problem I see is being able to qualify. I mean, you know,
And being able to qualify from that, does that have to be an improvement or can it be Mike new construction? Hey, because then if
it could
it's
be new construction, but how many, how many $2 million buildings get done in 30 months? You got to really, and now in this environment, and they did give you a little bit of an extender with this environment with the cost of materials, it's going to be pretty hard to meet that 30 months.
Have you seen it done well or done at scale well, or are there a few guys that are doing it well or not really?
I got one guy that's doing it pretty well, but the other ones are running into the struggle of, hey, how do I get enough to improve this building? I mean, we're capitalizing the leaking faucets, you know what I mean, to try to get them to get to where they got to be.
And there's probably a bunch of compliance shit going on with this, where it seems like the cost segment bonus is just simpler.
Yeah, the cost segment bonus, and like I said, I'm not a big fan of 1031, but buying a new building and taking the cost segment, taking the depreciation and going on with life, it's done deal. You don't have to sweat out the 30 months. You don't have to worry about whether that contractor shows up. You don't have to worry about whether plywood shows up or 2x4s or cement block.
What it sounds like, you don't have to worry about 3 in 2026. What the hell's going to happen with cap? You know, like,
Well,
I don't
I mean,
like unknowns. I hate. I mean, I like when Mike comes over and surprises me with a couple of beers, but I don't like other than that. I don't like surprises.
Now, and you know, here's the situation. You did that rollover in 2020, and in 2026, you're cash poor. And you've got, you know, $100,000 tax bill due. What do? Then you got to go through the offer and compromise process, installment payments, messes up your credit. I mean, it's a disaster. I mean, I see that this is the kind of stuff I see all the time.
Well, could you imagine if you're doing a syndication? Now you got 100 investors in a syndication. Now that becomes a cluster. I mean, could you imagine you and me talking to the investor on that one?
Yeah, but guess what? You gave us $200,000 and you now have a $80,000 gain. What are you going to do about it? So yeah.
Even one of the guys you could recently connect me, I won't say his name here. He was all like hunky dory about qualified opportunities. And I'm like, man, I don't know, man. I talk to Mike, man.
I try to shoot that down at some level. So yeah, but guys get IDs in their heads. You know what I mean?
They go to these seminars. Oh, look, hey, Mike, listen, there's this new thing, Mike. It's called a spendthrift trust. And I'm going to run everything through the spendthrift trust, Mike. And then I'm never going to pay taxes again. What do you think, Mike?
I got this life insurance policy where you can put in $500,000 and borrow $500,000 back, and it's all copacetic with the IRS, blah, 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 blah. Yeah, been there, done that. You could have a home office and set up a not-for-profit and deduct all your toilet paper. Seen that one too. Been around the block.
It's refreshing to have a guy like you on the team where, look, if something, like I've come to Mike with certain ideas, and if Mike says, hey, Ray, this has merit and what you're saying makes sense, like he goes, I haven't done this before and I haven't seen it done like that, but he'll look into it. But there's some things, like I see a lot of gurus or people on courses trying to say something like this whole spendthrift thing, trust. They'll charge you 40, 50 grand to do it, or take you to the Cook Islands somewhere, right? And set up an offshore. Like, dude, what do you like? Do you have a connection there? Like, understanding when and where you need these things is really, really important. And then the other reason I use Mike too is Mike's part of our asset protection team. So I'll bring in our asset protection people, talk to Mike. Hey, Mike, does it make sense to go offshore? Does it not? What do we got to file? What are the certificates? Like, Mike gets all that. So like, it's very easy to have that. Again, he did a lot of offshore stuff. He's like, well, where are you going to find that for that cost? He goes, well, I have this person here. Oh, okay, great. Do that. Yeah, that makes sense.
Yeah, a lot of the musicians that if I said their names, you would recognize them. I flew over to the Isle of Jersey from Heathrow Airport and set up their offshore trust because no one wants to pay the tax in the UK because number one is they audit your return every year.
Oh,
every year they audit every return. Number two is the tax rate's like 65%.
You meet a lot of people, you know, a lot of real estate guys. And again, I want to just be really clear. If you're going to reach out to Mike, reach out to me and then I'll connect you with Mike. Mike is a specialist in real estate. If you have a traditional return and you're a medical doctor and you're not doing any real estate, Mike could help you, but it's not really his thing. Like no. you can see anybody. If you're doing a lot of real estate or your wife's a real estate professional or you're looking to get into real estate, then you want someone like a Mike. But if not, you don't need them.
No. I mean, we like I said, we stay in our lane. Yep. And if you're a real estate person, that's what we do.
Yep. What are the biggest mistake you see people make with taxes?
Well, it's two things. Number one is just because someone has 3 letters after their name doesn't make them an expert. All right. You need to find someone that does what it is. And I'll tell you the biggest problem right now is finding a good bookkeeper. It's nearly impossible to find a good bookkeeper, and everything starts with your bookkeeper. If you don't have a good bookkeeper, someone that knows what they're doing, knows how to put your financial statements together, you're going to end up paying me a lot more money than you wanted to. Number one. Number two is you just don't know how your properties are operating. And I'm seeing this more and more. No one wants to be a bookkeeper. Jokingly, I said I could charge $200 an hour to be a bookkeeper and never have to file a tax return ever again, because no one knows a debit from a credit anymore. And it's a mess. Surround yourself with a good CPA, a good bookkeeper is a key to life, and a good attorney. And someone is on the same wavelength as you. A lot of times you'll get in bed with an attorney and the first words out of their mouth are no, because they're worried about liability this, liability that. You need an attorney that says, here's X, Y, Z, and here's the risk, or here's the reward. And do you want to do that? If so, here's how we got to do it. Not, hey, no. And I hear that there's a lot of attorneys, that's the first word out of their mouth, and then, they'll think about it, come back a week later and say, oh, it might work this way. Like I said, the key to life for a business person in this day and age is a good bookkeeper.
On the bookkeeper side, I agree 100%. A lot of these guys, they're flying blind. They don't have any metrics. And then because they don't have their books together, they don't have anyone reading them. Like, these are key gauges in your business. So again, I don't know if there's one of the, I'll speak for myself. I send Mike monthly reconciled financials.
Right.
And I don't know how many of the clients do that. But he looks at it in a second and he goes, okay, and so I think over time that's built a lot of trust, because like, this guy's got his shit together.
You have a business partner that may have the worst bookkeeping team I've ever seen. He will also go nameless.
Right.
But I mean, it's like, he'll send you his financials and he'll say they're through to the end of the year. And then he'll call you back 3 years later and say, oh no, they're through November only.
No,
I'm like, how do you not know that?
Right.
I mean, this is important stuff. And I know it seems trivial, but
it's not.
It's not. And if you have to pay your bookkeeper $50 to $60 an hour, that is money well spent, because that takes away from my $300 rate. It takes away from my staff.
Mike, I pay my $250 an hour, but he bangs that in an hour. We're done.
Yeah.
And then when you talk to him, hey, do this, this, and this. You want debit or credit here? What do you want done?
He's doing it while we're on the phone. Yeah, he's good. Yeah. He's good, but that's what you need. You're smart. You have a good bookkeeper. Most people, the one place you can't skip is on your professional team. And people who are adverse to paying professional fees should just go get a W-2 job.
You don't want a $10, $15 an hour bookkeeper. You want a CPA level or an accountant level, staff accountant level bookkeeper.
Even someone, there's like a qualification you can get for QuickBooks where they the
QuickBooks Pro.
Yeah, that's fine too.
Yep.
It's my dad used to always say, you buy good shoes because they last longer. This is the same thing. You pay for what you get.
Sometimes I'm like, I just paid all this money and he was done in an hour, right? Because he charged me a flat fee a month. And I'm like, yeah, but what about all the times he's got to do a whole bunch of other stuff? And he makes sure all my Florida state forms up, all the RT6, 941, you know what? So that Mike doesn't have to stress about that shit. Mike knows it's done.
Yeah, I don't like anything to do with payroll taxes. No.
All Mike sees is a W-2 and a pay stub. He's like, perfect.
Right. We spent some time working on the financials and cleaning them up, but it's not crazy arduous. It's not like you've got automobile expense on the balance sheet. You know what I mean? It's all makes sense. But like, seriously, this is the biggest problem I've seen over the last 3 to 5 years, is no one can find a good bookkeeper.
We'll do an episode with our bookkeeper on. If you guys want, let me know. We'll have him on and we'll share what that looks like. And again, a lot of this stuff can be done remotely. And if your bookkeeper is good at QuickBooks, a lot of this can really be automated. Like, you don't have to sit there and enter every single thing. Like a lot of this can be synced up. So, and then you can have recurring transactions. Like, you can say, we do it in-house. I mean, he reconciles, but we do our books in-house. It takes us an hour or two a month. It isn't a big headache. The thing is that it takes time to get it set up. But once you get your account set up and everything else, it just makes Mike's life easy, because now he can look at it and then he can tax plan. Guys, you really want your CPA tax planning. You want to give him what you got and then plan. And if Mike can't look at my stuff in 10 minutes and tell me what to do, then I messed up. I'm not giving him good data. So he's got to scrounge, and then he gets frustrated because he's like, dude, I don't want to do this crap either.
No, I don't want to dig through your financial statements. I want to make sure they're good, give it a look through. I've been doing this long enough, I can look at it pretty quickly if they're good and figure out what the issue. If I can't, I've been wasting the last 35 years of my life, I guess.
Mike, what kind of attorney do you recommend? Is like a general counsel real estate attorney, or more like an asset protection attorney? What are you talking about there?
Find the guy for whatever job you're doing, but you want to have a general business attorney that you can rely on, that is smart enough to tell you what he doesn't know and refer you to the person that does. As I said this earlier today, the definition of knowledge is knowing where to find the answer. It's not knowing the answer, it's knowing where to find the answer. So the guy that's big enough and broad enough to say, I'm not sure, but I know Joe Smith knows the answer to this because he does this every day. That's the guy you want. You don't want to have a guy with an ego that says, I can do everything, because there's too much stuff going on now.
Right.
You know, Wayne sticks to his lane. I stick to my lane. I've got a guy that looks it over all my real estate stuff.
Sure.
You know, and then I got another guy that's my business attorney, and I got another person for my estate tax stuff.
Sure.
So, you know, you find the specialist.
Find a CPA that is willing to play ball like that. Like, for example, on the crypto, well, I think I have a guy, and we'll interview him if he pans out, that Mike's going to go check, see if he knows his stuff, test him, and then vice versa, they test each other. And then now that becomes our crypto leg expert on this side. But Mike knows, hey, Ray, we need some help. He'll tell me, hey, Ray, we need some help here. I'm not an expert here. Let's get some. I can do my part, but this is not what I do day in, day out. That's what you want ultimately in a team.
You know what you get when you get gray hair? You know what you don't know.
Humility, a little humility.
Yeah, and you admit it. Like, I just don't know. You know, or I got a basic understanding, but we need to bring someone in who specializes in this area. I mean, if you were going to the doctor and your general practitioner said you need to have a heart transplant, and I'm going to do it, what would you do? I'd run out of that doctor's office in a minute.
But the weird thing is, generally, Mike, in that profession who attracts CPAs and those kind of high-level accountants, it's the guys that are generally smart. And the guys that are generally smart, to them, it's like a ding on their ego if they say, hey, I don't know, or I got to find somebody else. I love the I don't knows, because then we can figure it out as a team. I love that.
I'm with you. No, Ray, I have an ex-wife. There's nothing you could say to me that's going to hurt my feelings. And I've been called everything in the book. I'm okay with saying I don't know.
No, that's perfect, dude.
You know?
Yeah, and I love what you said too, because I heard this somewhere. I forget where I heard it from. Might have been Tom Wheelwright. He's like, don't tell me no. Tell me what do we got to do to make that happen? Yeah. Like, because it's not whether this is deductible or not. If I change my facts, then we can change the tax.
Right. My dad used to always say, I don't want excuses, I want results.
100%.
And I live by that. That is something that's stuck in my head all these years.
100%.
Yeah.
100%. Mike, on terms of investment opportunities, what are you seeing right now that makes sense? Because both you and I, again, I've done a lot of opportunities that I've found, and then Mike has helped me put together with his team, with his investors, and vice versa, where Mike has found the opportunity, and then I got the capital, we figured it out together. So ultimately, you want to get to a place where your CPA is also a great CPA and a great team member, but you're also now working with each other's networks. I send him people, he sends me people, he sends me deals, I send him deals. Like how great is that? I don't have to go anywhere else. Like that's where like the blessing of my life is in magic. That's what you really want.
Right. I mean, right now it's tertiary markets. You know, the cap rates in Florida, Texas, California are out of control, but you know, in Wickliffe, Ohio, they're not bad. In Oklahoma, they're not bad. I'm seeing guys pick up deals in, nowhere, New Hampshire, in Maine, Alabama, out of the major cities. If you have properties in a major market right now and they're not up for sale, shame on you, because you're going to get
for sale.
money. You're going to get crazy money. But if you're in Enid, Oklahoma, there's opportunities to buy there. I wouldn't touch anything. My guys in California, Texas, and Florida are selling stuff for dollars. I have a house in Florida, and my wife and son were down there last week. Someone stopped her in the driveway. We bought this house at the end of 2018. And mind you, it's 2,500 square foot ranch. It's on a canal. It's got a nice fence around it. Someone offered her $75,000 more than what we paid for it at the end of 18 in the driveway.
You could probably get a whole lot more. Put it on the market.
Yeah, I know. And I'm like, I actually, that's my favorite house because I can go down there and not do anything.
Right.
It's pretty new. So I enjoy that house. If someone doubled the price, I might think about it. But right now, no.
Yeah, you're in a good place. You deal with a lot of entrepreneurs, both in the real estate space and different spaces on entrepreneurship. What do you think? Now I'm talking more about legacy, generational wealth. As you've worked with clients long enough at your age to kind of see them go through generations. What are the mistakes there that prevent them from going to A to B to C? Like what mistakes do you see there from that side? The
businesses I've seen that have been successful to transition, dad and son got along well, grandpa and father got along well, and people were able to check their egos and move forward. The businesses I've seen that have gotten blown up is where dad is trying to have a power play on Johnny and grandpa is trying to have a power play on both of them. It's, if you want the transition to happen, Everyone's got to play nice in the sandbox or it's just not going to happen. It's egos that kill these family deals, and someone, I actually have a client, the original building was built in 1948. They are now to the third generation. I started working with the grandfathers, I've worked with the fathers, and now some of the kids are coming into it. And it's a group of people that the grandfathers, 3 grandfathers were friends, so it's kind of spread out. It's gone from 3 to now 30 people that own part of this building, and they all play nice. Okay. No one's fighting with each other. The grandfathers transition to the fathers transition to the kids, and all the kids get along. They all grew up together. There's not a problem. But then, I've got a business where this is the best. The brother took over the business. It was owned 20% by the 5 kids, but the other 4 kids weren't involved. He bought the other 4 kids out for $400,000 each, and 6 months later sold the business for $20 million. Do you think he turned around and took care of his siblings? Hell no. You got to have some ethics and morality to do this thing especially with your family. I mean, come on.
Make sure you do a good job as a dad, because like you're a dad now. Well, you've been a dad before, but
I've been a dad before. I'm a dad again. Yeah.
Yeah, you're dad again now. I'm just because what I see, Mike, in my opinion, in my profession, as I ask this question of a lot wealthier guys, I happen to meet the Portland Trailblazers when they drafted Michael Jordan, or they didn't draft Michael Jordan. That owner of that team, I stayed at his house and I asked some of the grandsons the questions, and he goes, Ray, when you try and pass on generational wealth, what happens is everyone's in a little bit different situation. Some people might need money now, some people are bad money management, but when you try and control things from the grave, and it gets really complicated, but B, the values of the grandfather weren't properly passed down to everyone on the food chain, so they don't live by the same core values and principles.
Right.
I think that goes back to parenting. What are your thoughts, Mike?
I have a 31-year-old, 29-year-old, 23-year-old, and a 2.5-year-old. And my parenting skills have evolved through those upper 3. The upper 3, when my oldest child was born, I was making $37,000 a year. Okay. So I was busting my ass to pay the bills. Now it's a different story. I try to leave the office by 5, hang out with Max. If I have to go in earlier, that's okay. He's asleep. Right. Try to hang out with Max. And you try to teach him, my wife is Eastern European. I don't have any problems with teach the value of a dollar because, it's a mindset where you earn every dollar. It's not given to you. One of the things my dad did was back in the day when you actually had to pump gas when I was in high school, my dad, I had a hard time talking to people. My dad made me get a job at a gas station where I had to go up to the car and say, how much do you want? Can I check your oil and wash your windshield? Okay. And that seems pretty trivial, but it made it so that I could talk to people. All my older kids had jobs when they were 16, and they've all turned out very well because of that, because they have a work ethic. The work ethic, I get up every day at 5, maybe a half an hour before I get to my computer, but I get to it. And that work ethic is everything. There's no easy money.
There's no substitute around you showing up and doing the work. And that's when how do you meet great guys like Mike? Well, then as you're showing up every day, then just magic happens, right? But and for me, it was at Winn-Dixie. I was a bag boy at Winn-Dixie at 14 or 15. But it taught me all the skills. It taught me the hustle. Hey, if I was able to back more carts, I get more tips. And then when you buy some nice shoes or whatever you want to buy, you've actually valued that dollar because you earned it. And that muscle you got from earning it, no one can take away. And that's those same skills really transfer over to business. Very, very easy.
My first job, we moved in March and I was cleaning out some stuff. I found one of my pay stubs for my first job. The hourly rate back then, minimum wage was $1.35.
Jesus.
Yeah. Yeah. And so if you worked 8 hours, what you made like $10, $12. Sure. But you're like, whoa, this is a lot of money. Gas was 99 cents back then. Sure. So it seemed like a lot of money, but it taught me a lot about going to work every day. You know what I mean? And punching the clock and doing what you got to do.
I think the other thing there too is a little bit of delayed gratification. You want to give yourself things, but you also want to earn them. And then the more you can set them aside initially, that really starts to pay dividends on there. Have you seen that, Mike, in your life and your clients? Because you got clients that are really, really wealthy.
Yeah. I mean, my biggest client has $1 billion worth of real estate. He's always wanted to build a basketball court in his backyard. So during COVID last year, I said, now's the time to do it.
Yeah, build it.
I said, you're stuck in your house. I said, build a basketball court. You got the money. You got the room. Just go do it. Stop putting it off. And I was out there a couple weeks ago playing basketball with him. So the answer is he finally did it. It turned out beautiful. He did full bore, everything nice. But I'm like, this is a guy that could have afforded to buy the Q Arena downtown, and he's stalling building a basketball court.
I find that initial muscle that got us to where we are, the hard working, the drive, the delayed gratification, then when you actually want to give yourself something, it becomes hard too. Have you found that? Well, this is like, because you're not used to it, you're used to the other stuff, but kind of what got you out of Egypt won't get you to the promised land, right? Have you found that as well?
Yeah, I mean, like I try to buy myself, after busy season, I try to buy myself something nice every year. Like the year before Ali died, I bought an autographed picture of him knocking out Sonny Liston.
Oh, nice.
You know, small things like that. I mean, art. Last year I bought myself a Picasso, which I've always wanted my entire life. But you know how hard it was to write that check, even though because of COVID, it was about a quarter of what the last time it traded for. It was painful to send that money to that guy to get that piece of artwork. But it's hanging in my living room now, and I look at it every day, and I'm happy I did it. But the answer is, I know how much effort it took to be able to afford that and how much work I put into it. And yeah, it's nice to pat yourself on the back, but you got to do it at the right times, at the right places.
It takes a little bit to get there. It takes a little, because it's not a new muscle you're learning. And then, but if you don't, kind of like the charity muscle, if you don't start giving, if you don't give $1 out of 10, dude, you'll never give $1 million out of 10 million. Like you're just like, so you want to kind of, what got you from level A to level B won't get you from B to C. So you've got to start to then give yourself some of these things and also give to others. What I find when I give to others, just it opens up all sorts of doors.
Yeah, I agree. You know, someone today said their daughter's getting married. I am not able to attend. I obviously sent a check, and they sent me this really nice note about how generous it was. And then he called me and said, that was an unbelievable gift. I'm like, hey, they're a young couple trying to start out. That money means, that amount of money means a hell of a lot more to them than to me, but you're also doing something good. You're greasing the wheels of what's moving forward.
100%. I think it's a great spot to leave it off, man. Mike, I really appreciate it. Thank you for your time,
Thanks,
brother.
Ryan. Have a good one.
Thank you, brother. I'll see you soon.
Brother. Yep.
Later,
See
brother.
ya. Bye.